Hi guys, this is the Smart Invest. In today's episode, we'll take a closer look at Palantir and try to determine its valuation. There's a lot of buzz surrounding Palantir and the immense opportunities it holds. In this segment, we'll delve into the fundamentals of the company. The first thing we consider in such cases is the PE and forward PE ratios. As you can see, Palantir doesn't have a PE ratio since it hasn't generated profits in the last 12 months. Based on a forward PE of 59, analysts expect the company to turn a profit in the next 12 months. From these two indicators, we've already learned that the company isn't currently profitable, and they anticipate only about a 1.9% per share profit in the next year. Based on these metrics, the company's shares could be considered rather expensive, but fast-growing small companies often operate at higher PE values than the average. Next, we'll examine the company's value and revenue. As we can see, Palantir's market capitalization is $33 billion, while its revenue was only $2 billion TTM, trailing 12 months. From this, we can see that the company operates at APS, price-to-sales, ratio of around 17, which isn't considered cheap, not even for software companies. But if the company isn't profitable, how does it finance its operations and why is it worth $33 billion? Apart from the fact that Cathie Wood recently reinvested in the company. Is this a signal of when to sell? How? But let's get back to the main point. How does Palantir generate revenue? Yes, you guessed it. Palantir aggressively issues shares to sustain a positive cash flow. The downside is that, even if you're a shareholder in the company, your ownership stake keeps diminishing because the company constantly inflates its shares. If you find this video helpful and educational, please hit the like button to support my work, and don't forget to subscribe and hit the bell icon so you can access even more valuable content in the future. But at least the company's revenues are rising rapidly, right? Well, not really. While the company's revenues are indeed increasing, their growth rate has significantly slowed down, as you can see. But surely, they're pouring more money into research and development, as we're talking about a promising tech company. Actually, no. As we can see, the company's research and development expenses have been stagnant for years. They seem to have run out of things to research. In contrast, they spend 3 times as much money on things like salaries and wages, other than direct labor for production employees, advertising and marketing, insurance, license fees, office supplies, accounting costs, maintenance and repairs, distribution expenses, rent, travel, utilities, vehicle expenses, legal fees, equipment not associated with manufacturing. This is a tech company. When we look at the company's valuation relative to itself, we realize that it's not as cheap as it might seem, especially considering the slowdown in revenue growth. So, what justifies the $33 billion market cap? Surely, analysts are expecting some significant future profit. Not really. As we can see, not even the often optimistic analysts anticipate a substantial future profit growth. Based on this public information, everyone can draw their conclusions regarding the company's valuation. In many cases, it might be better not to jump on the hype train. Thank you for watching the video, and if you found it helpful and want to support my work, please hit the like button. Subscribe and ring the bell to catch similar valuable content in the future. If you have any questions, feel free to ask in the comments section, and see you in the next episode.